Good afternoon and good morning, everyone. It's Ted Bader, President of SIA Wealth here, and thank you all for joining us for this SIA Wealth Market Outlook. Today, we're going to talk a bit about some of the sub-advisory funds that we manage for BMO, as well as give you a market outlook in terms of what we're seeing happening in the markets today. Before that happens, I'm going to give you a brief little outline. 2020, as most everyone knows, has been quite tumultuous. As far as the positioning of some of the mandates that we manage, we're quite pleased, and I understand that timing is everything, but the reality is we've always positioned our funds as a tactical strategy that will adapt to the current environment, from avoiding the worst of the drop-offs in March. Yes, we missed out a bit on April, but we eventually participated by the end, and catching up to our benchmarks in the subsequent few months. Up until the end of August, we've had a very, very strong performance with the stock selection, relative strength, sector allocation that we've been looking at. Paul will talk a bit more about that. But to be honest, using our funds as a tactical complement has really been able to take risk off the table and yet continue to participate when markets continue to go well. There is a lot of uncertainty. No one knows what's going to happen into the rest of the year. And all I can say is that we're poised to be very adaptive and adaptable to any scenario that's presented at us from an individual stock point of view, from a sector allocation point of view, as well as a macro buying stocks or not buying stocks point of view. So I just wanted to address that with everyone. We appreciate your support, and I think it's really important to understand where some of our funds fit as a nice complement to some of those existing long-only strategies, which might have looked and have better performance numbers year to date, but the reality was back in March, they were fully invested as well, and they participated far more on the downside. So what we're talking about is a complement for a balanced portfolio, and we do want to have that as a successful overarching strategy. So I'm going to pass it over to Paul. A couple housekeeping tips. If there's any questions, please fill out, type the questions in on the question tab. We'll adjust those after the fact, and please address the questions to the existing market update or the funds, and we can answer appropriately. But Paul Vendritzky is going to talk a bit about the funds, and then Colin Sazinski is going to give you a bit of a market update as our chief market strategist. And again, as usual, if there's any questions, type them out or feel free to reach out to us afterwards. Thanks.
Thanks a lot, Ted, and thanks for everyone who's joined us here today. As Ted mentioned, I'm going to cover the 5 funds here that we sub-advise for BMO, and I'm told that you should be seeing commentary for the end of August coming out very soon, the next day or two. So it'll give you a little bit more detail on what may have changed and updates within the fund. Before I start off looking at each of these, I just want to start off by saying, especially if we're joined with people who aren't that familiar with these, all of these products, all 5 of these funds are really intended to fit within an already diversified and balanced portfolio. The insurance policy, as Ted mentioned sometimes, or our risk management overlay within the equity funds, again, allows the shift tactically toward or of course away from equity exposure depending on our macro view. So within a portfolio, that sleeve will automatically shift the overall portfolio's asset allocation weights automatically without you needing to do anything, depending, of course, on our changes within the funds. Speaking of which, we've seen, as Ted mentioned, a lot of strength over the past 4 months, which of course coincides with our move back into the equity markets at the end of April. Also, as Ted mentioned, there was some catch-up that was required for certain markets, for certain funds because of our time away from the equities. Certain products here have already exceeded those moves or benchmarks. Some are still working on that, that year to date, working on getting positive. But across all of the funds, we're definitely exposed to where we're seeing strength. We're very comfortable with how they all look. As Ted mentioned, going into the fall and into 2021, we're seeing massive uncertainty here, whether it's the COVID and how that may be seen within the stock markets, whether it's the U.S. election, the trade, or something we haven't even seen yet. These kind of products are going to be very helpful in times of uncertainty and then possible volatility, depending on what happens. So definitely something to keep your eye on, or take a look at these if you haven't already. So the first fund here, the BMO Tactical Global Equity ETF Fund. Now, this is our longest running mandate. This started April 2015. And a lot of advisors, whether it's this product or just our philosophy, ask a lot of times how to describe what we're doing, what we do overall. I look at this fund as more of almost like a market neutral absolute return fund. It has the word equity in the name, but let's face it, this has the ability to go completely out of equities into short-term bonds, cash equivalents. So it has the ability, like a market neutral fund, to really go into a lot of different places and asset allocations. The fact that over the 5 years that this fund's been running, it's mostly in equities, doesn't necessarily mean that it's how it'll look in the future. So, that's how I would describe this fund. And, something with a 5.5 almost annualized rate of return is a good return for a product such as this. We're looking at the short term. Yeah, it's had a tremendous run since moving back into the market. It's up almost 15% from early May or the end of April, sorry, to the end of August. Has had a good run, and a lot of that has to do with where the fund is concentrated in. So we hold ETFs and individual stocks, but overall, we're seeing strength in healthcare, IT, and consumer discretionaries. This can change substantially over the next 6 months, but based on the relative strength rankings, we are able to play that catch up, so to speak, because we're invested where we're seeing outperformance. So those are the kind of names, and it's a bit of a repetition through a lot of the other funds, because that's where we're seeing strength, even whether it's the U.S. or Canada. So this is done great, but again, I think of it as a sleeve within a balanced equity fund. This could be seen more as the global conservative approach, if you wanted to label this. The next fund is the BMO Tactical Global Bond ETF Fund. The way to look at this product, this is our alpha bond strategy, right? Again, as a sleeve within an already conservative, say, Canadian, mostly fixed income portfolio, this is the sleeve that's going to take on more risk. This is the fund that looks at cash flows and yield outside of Canada. So it works nicely within, say, a diversified Canadian portfolio where we're looking into the US. It will take risk on corporate bond sides. And because I call it the alpha fund, we saw years like 2019 where the fund almost gained 10%, one of the top performing funds in the country, because it was able to take on that risk. But no different than what we saw in the equities markets in March. The pullback in the drawdown was due to the corporate bond. So we saw the upside last year, a pullback this year, and we're going to continue a little bit here on the catch up in the year to date. I think even looking at the last 2 weeks, these numbers are at the end of August, we've already gained about 1.5%. So that year to date is about -5. So again, we're positioned where we're seeing strength. It's less exposed to the corporate bonds, more on the governments, longer duration than we saw in the at the start of the year. But again, we're seeing strength in the U.S. still, and the fund will rotate dependent on that. But it's positioned very well to where we need to be. The next one is the BMO Tactical Global Asset Allocation ETF. So this is a combination between the two, where I said the BMO Equity Fund is more of a balanced global conservative fund. This is similar, except if you need a specific and constant exposure to fixed income, this is the portfolio you would look at. Whether it's a 60% or 40%, it's always going to own a certain amount of fixed income. And the strength we've been seeing in in technology, healthcare, and consumer discretionary, for instance, are also the things that are helping this fund since we moved back into that green equity action call. So year to date, we're almost at that positive mark with help of what we're seeing lately. 4 months, almost 7%. It's been a good quarter or 3 month period. And this will rotate based on our macro view towards or away from equities, depending on what we see going forward. And again, very volatile or potentially volatile 6 months coming up here. The next is our focused stock strategy. So, people ask about a comparison between the BMO equity and this, for instance. This is more pinpointed into the individual stock, the actual company, rather than the ETF. But it takes a fairly similar approach. This is more of an alpha, I guess, compared because it's looking at the individual names. But it's a similar idea. We're going to invest in strength on either side of the border, Canada or the US, and we're seeing strength in those similar sectors. You can see here, tech, healthcare, and consumers. Last week was a bit of a pullback in certain technology names, and Colin will look at some charts here in a bit, but that wasn't something to change the portfolio because of 1 week at all, and we're seeing a good rebound this week. So we're still holding most of these names. Some of the names on the top 10 list have shifted this month. I won't comment on that right now, but we've seen 14+% since moving back into the equity markets as of April, and a year-to-date number that it's positive at this time. So not only was there a catch-up, but we've surpassed it and looking pretty good and well-positioned. And then last but not least, the BMO SIA Focus Canadian Equity Fund. Now, this is our concentrated Canadian equity strategy. Similar story to the rest as far as how we rotate. Canada here, the fund is a little bit more diversified. We have some exposure to energy and the materials, which have traditionally been more volatile. So 1 week it's the base metals that are doing well. Next is the precious, sometimes neither. So this one has been a little bit more active, a little bit more of a turnover. And since getting back into the markets, it overall has done very well, 13.5%. We're still working on crossing into the positive territory for the year. But again, well-positioned where we're seeing strength within the Canadian equity markets, and we'll continue to use our rules-based approach, of course, to manage all of these and go forward. Before I pass it on to Colin, just a reminder that every one of these, and they're going to work differently depending on your clients and what their needs are, but all of these could be used as a sleeve to help shift that overall asset allocation depending on our macro call. We're trying to protect from downside volatility, which may or may not show its ugly head again this year, but there's a lot of reason why it potentially could. So this is a good way to manage that risk. If you have any questions, we're always available through calls or email if you want to discuss these individual products and how they might fit in with the client's portfolio. Thank you, everyone. I'll pass it to Colin, who will continue with some charts and outlooks. Thanks.
Fantastic. Thank you very much, Paul. And we'll move on now to our monthly market update. And I guess basically, just to take a bit of a high-level look first, is that this is a year where seasonality pretty much has been thrown out the window. We saw that often in the late winter, early spring, when markets historically have been strong, we had a massive crash. And then this is the time of year where markets are a little bit historically more volatile or weaker. And so far, at least through August, things held up pretty well. Into September, we did see a bit of a correction in the markets, and I will speak to that in a couple of minutes. But first of all, generally speaking, looking at the SIA Charts equity action call, we continue to remain near the top of the green zone. Equities are continuing to attract significant capital relative to other asset classes. Looking at the second level of analysis, the SIA Charts asset class rankings, we'll note that over the last month, the big change has been that Canadian equities moved up from 5th place to 3rd. We have international still first and U.S. equities still second. So equity asset classes are holding down the top 3 spots, hence the high ranking in the equity action call as well. The neutral asset classes of cash and currency are sitting in 4th and 5th. Bonds and commodities are continuing to trail behind and have been weaker relative to the equity asset classes. So overall, stocks still continue to attract significant capital, even through the volatility of the last couple of weeks. The market equal weight index is also continuing to climb. It's moved up a little bit from a month ago. It's still building on a recent breakout with some upside room. And what's important here, and we'll show in a number of these slides, was that we did have a 10% pullback in the Nasdaq in 3 days. And so that was quite a sizable correction in a pretty short amount of time. But the reality was that a lot of that was contained within the Nasdaq, within a certain group of stocks, let's call them high momentum stocks, had a big correction. But the broader market, let's call it, might have bent but not broken. It wobbled a little bit, but basically the foundations of the bull market remained intact. We didn't see things really crumble. What we saw was still looking at this point like a correction within a broader bull market. I wanted to highlight, this is something that I like to look at, is a chart within SIA Charts called the sector scopes. And what it does for me is it's a visual representation of what's happening with different sectors. Sectors that are stronger are on the right-hand side. Sectors that are weaker are on the left-hand side. And generally speaking, if you figured a neutral market would have something like a normal distribution where majority of the sectors would be piled up in the middle, and then you'd go down and have a lower number at the extremes. The far right being leaning towards overbought, the far left leaning towards oversold. Where we found ourselves at the beginning of September was that all the sectors were starting to pile up on the right-hand side, indicative of a bull market, but starting to get a little bit heavy, starting to get a little bit overbought. Following the correction that we did have, if we look at the bottom half of this chart is the current representation, and what we're seeing now is the most extreme right end has come back down, and we're seeing more of the sectors kind of piled up in the middle, slightly to the right. That again is indicative of a bull market situation where we were in an overbought. We've kind of eased back into the middle, but the underlying bull market remains intact. Looking at international equities, similar to the overall market equal weight index, we've seen a little bit of improvement this month, but at the same time, this index is bumping into resistance and has not broken out yet. Should it break out, we could see room to the upside, and most importantly, we did not see any kind of a correction. A correction on these charts would be a drop of about 6%. To signal a correction, a move into a column of O's, and in international equities we did not see that, so it was a fairly moderate pullback. For U.S. equities, the same sort of thing. It's number 2 in our the asset class rankings. It did break out in August and has continued to climb in September. It is approaching some resistance with further upside. Something to note with U.S. equities is that, of course, in addition to the U.S. economic recovery, U.S. equity prices, particularly for more global stocks, may also be benefiting from a weakening in the U.S. dollar. All else being equal, when your currency goes down, if you're a global stock, then the price in some currencies can go up. So this is the Nasdaq Composite, and this is a particular significance. This is a market cap weighted index. So and what we saw with the Nasdaq was it did encounter resistance near 12,250 and found support around 10,790. As I mentioned, it had a 10% correction in 3 trading days between a Thursday close and a Tuesday close, because the long weekend was in there. On a high pull warning, so this signal is called a high pull warning, and what that is it has retraced more than 50% of its previous rally. So it had a big rally, which we call a pull, and it's given back more than half of that. So that was it's a fairly sizable correction. To call this off and to start indicating that the Nasdaq's heading back up again, it needs to regain the 11,340 level. So I'll note here that the market cap weighted version of the Nasdaq has had a fairly sizable correction. On the other hand, going to the next slide is the Nasdaq equal weight index, which is it takes out the market cap effect and equal weights everything. And here it remains in an upward trend. There was no 6% correction, and what this tells me in particular was that the recent pullback in the Nasdaq was focused on a very small number of very big cap names and momentum names, and the Teslas of the world was the poster child of this particular correction, but basically there was a small number of high momentum names that had been driving things up, that they were the ones that corrected. But what this tells us underneath is that the other things we're basically holding in, the regional banks in the Nasdaq, the healthcare companies in the Nasdaq, and some of the other things didn't get hit as hard as this small group of momentum stocks. That's good for breadth. That's really supportive supportive of the bull market and indicating that investors were showing support for equities. It's also possible we could have had some profit taking in some of the momentum names and capital being spread out into a wider area, and that's also, generally speaking, a great breadth signal. The Canadian market has been particularly strong, relatively speaking, lately. It's moved up from number 3 in the asset class rankings from number 5. It's continued to climb, building on its summer breakouts from a downtrend, and has continued to work its way upward. It is approaching some resistance. In the last month, we've seen quite a bit of attention in the mining sector has done particularly well. In where we had seen some corrections in some of the technology, communications, momentum kind of stocks, the similar kind of sectors to where we had seen the correction focused in the United States. The Canadian dollar has been strong relative to the US dollar of late, and so this is helping Canadian equities to strengthen relative to US equities. And also, considering that a certain amount of the cash, when we look at cash and currency having dropped down and Canadian equities having gone up, the improvement in the Canadian dollar could also be a factor driving behind that. And so here we're showing US dollar CAD, and the strength in the Canadian dollar. This chart goes up and down with the US dollar. So the recent trend of this coming down is the Canadian dollar strengthening relative to the US. We saw the peak back in March. We kind of consolidated. We've kind of been a step down where we had a sell-off in April, consolidated for a bit, drop in June, consolidated through the summer, and then another decline here in August, and now into September. We did break an uptrend line, so this was we were into a pretty decisive downturn for US dollar CAD. Next potential support is around 130, then around 127.85 or so, based on some previous lows that we had seen previously, and so we're on a bearish or downward signal for the US dollar CAD at the moment. Looking at just going to look at a couple of other markets here. Gold has been on a tear since the summer of 2019, and just as I talked about the step pattern down for the US dollar CAD, we're in a step pattern up for gold, where we have big rallies, consolidations at a higher level, big rallies, and so on. We had one in April, and then we had one between June and August. The August we saw gold peak up around 2085. It's dropped back under the 2,000 an ounce level, but it's also picked up support around 1900. So at this point, it's looking like gold has shifted from one of its rally phases to one of its consolidation phases. As we can see on the chart, this is not unusual for this to move into a more upward signal again, upward trend signs. We needed to get back above the 2,000 round number. Until then, it's just kind of sitting in a consolidation kind of zone. Sorry. Crude oil. Crude oil, of course, has been all over the place in the last couple of years. It was already trending down in the latter part of 2019 and into 2020, and then it had that huge crash back in the spring and the huge rebound into the summer. And now crude basically, to me, seems to be settling into a 35 to 45 kind of range, and there's a lot of different things going on that are impacting it from day to day. Right now, we've seen some strength because hurricanes have shut in production in the U.S. Gulf of Mexico. Tomorrow, we've got OPEC having a meeting, sitting down to discuss what they're going to do, and so on, and it goes back and forth. But the basic point is that we've moved into a situation where there's this uncertain outlook for demand. Demand has come down quite a bit. The demand forecasts that came out this week from OPEC and other international agencies were basically indicating a decline in demand of about 10% from a year ago, give or take. And so and in that kind of an environment, then it's how do you manage supply within that because the problem is if you go down to $10 or whatever it was a barrel, everybody goes broke, and nobody wants to do that. So they all want a price where people are making enough money to go on, but at the same time, it's hard to see how crude is going to go beyond and keep on going higher when demand is struggling. So we're kind of settling into a range is how it appears to be. And so that concludes my prepared remarks at this time. This is our fund codes, and I'll turn the floor back over to Ted to take care of any questions that you might have.
Great, thanks, Colin. Again, if there's any questions regarding our market outlook or our funds in particular, feel free to type them into the question box. But I have a couple here that I'm going to ask. First, one is directed to Colin. Obviously we've seen this rally, and there's a lot of talk about the tech stocks and how there's a handful of companies that have really driven the market. Have we seen any increasing breadth in any of the other names? What I mean is that is this a sustained bull market, or are we just kind of momentum moving these companies up to potentially hit a peak? I think that's one of the biggest questions we get a lot of days as well. Is there a lot of breadth in the market, or are we seeing this increasing?
Even though the Nasdaq has been getting most of the attention, particularly in the media, the reality is the breadth actually is continuing to increase and improve. If we look at things like the Dow Transports, which lagged through much of the early recovery with the airlines getting smashed, that the Dow Transports are actually pretty much back up to where they were before, and we've seen back up at their old highs. They've played catch up lately. We've seen the small cap stocks in the Russell 2000 also playing a lot of catch up and doing quite well. So yes, we have seen the breadth continuing to improve through this, and not just in equity markets, but also in commodities. In the initial rallies we'd seen in commodities were in the more economically sensitive areas like crude oil, copper, and lumber in particular. But of late we've seen gains in a broader range of commodities, into some of the soft commodities, and the grains have all been breaking out, and so that's important too, is in a number of different areas, not just within equity markets, but also in commodities. And even I'll note the breadth in terms of, we like to talk about tech, but in fact it's the international equities that are in top spot in the asset class rankings. So we're seeing good breadth, both in terms of geographically and increasing breadth across sectors as well. Even when I showed the sector scopes, we could see that it's not one or two sectors doing really well and everything else doing badly. It was quite concentrated around the middle. So there's a wide group of sectors, a wide group of stocks that have been doing, that are attracting interest, and that's a positive sign.
Okay, thanks. I guess it's a follow-up question. Is we're 6-7 weeks out from the election in the U.S., and a lot of people are kind of holding their breath to see what happens. Is there anything that we've seen? Maybe this is for Colin or Paul. Is there anything? Have we seen any changes in some of the stocks or the relative strength of sectors to indicate any preference? Or, any money movement? Is there any money in flow? I think the answer is no. It's kind of continuing on as normal, but I'll let either Colin answer that or not. Go ahead.
Sure. I'll just say this, and if anyone else wants to add anything. To date, we haven't seen much of an election impact on the markets. That certainly could change in the next few weeks, and in particular, if you get to the one we're keeping an eye on is what happens afterwards. Do you have a decisive result or an indecisive result? In terms of going back to in 2016, clearly there was a lot of uncertainty, and remember at that time markets had sold off heading into the vote. And then as soon as it was announced, the winner was announced, being President Trump, the markets took off and never looked back. But then on the other hand, if you go back to 2000, where the election result was contested, the markets struggled for quite some time afterwards, and they weren't going into an extended bear market at that time anyways, but that was certainly something that uncertainty about the results was something that that did weigh on markets. Markets hate uncertainty and hate political uncertainty. So it's like once you get a winner, you can look at their what they said they were going to do, and people can decide, well, who do we think is going to win or lose based on whether Biden's in power or Trump's in power or whatever. But the one that the markets, when that really tends to drive the markets crazy is when there's uncertainty.
Yeah, and again, that's also ties into the strategies when we run. Our system isn't predictive. We're not trying to figure out what happens before it happens, because a lot of times these decisions need to be made, and then that money will flow accordingly. So what we're trying to do is pick up on those. Our job is obviously to make it as adaptive and responsive as possible, and I think we've come a long way in that regard. And going forward, I really do believe that we are positioned for the rest of 2020 and beyond, even depending on what happens from a election result point of view or an economic downturn point of view. And that's why we keep on talking about the positioning side. Is we're not fully invested come hell or high water. We are really tactical, and that's why it is some of the funds that we run are very nice complements to existing long only strategies. So you get that bit of safety for those uncertain times. So it looks like we don't have any other questions. We're going to wrap it up from there, but thank you everyone for dialing in and listening to our market updates. We're going to do these on a fairly regular basis now that the summer's over. So if there's any questions or anyone has anything they want to ask, feel free to reach out to anyone on the SIA team, anyone on the BMO team, and we're more than happy to have that conversation. So thanks everyone. Colin, Paul, thank you all, and we'll talk to you everyone later.